This episode, as with all episodes, exists thanks to the supporters of the show who contribute a mere $3 per month via patreon.com/copytradersclub. You can too. It takes 2 minutes to sign up and you probably won't feel it. What you will feel is a warm, fuzzy feeling of helping out a little independent podcaster who creates a show you enjoy and get value from. Patreon.com/copytradersclub. Thanks for listening and thanks for your support. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin McCauley, my name and username on eToro. Today we talk to an experienced investor who cut his teeth in the City of London and is now bringing his skills to eToro. Here we go. Episode 18 of the Copytraders Club podcast, and as always my aim as an eToro enthusiast and copy trader is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, the aim is to answer all your questions about this popular investor and reveal more about them than anywhere else, so you can assess whether they might suit you. In this episode, we talk to Ben Sparham, a low-risk PI aiming to provide a steady, all-weather portfolio. Speaking of the weather, it's a beautiful day here at the Copytraders Clubhouse, and we convinced Ben to drop by for a chat before we play a few holes of golf. Having sent our driver, he has come a fair way, but now, dressed to a T, we witness his approach. Ben, hello. Welcome to Copytraders Club.
How you doing? Pleasure being here. Thanks for having me.
Well, the pleasure's all ours. And first thing we got to do is get you past security into the VIP lounge by a series of quickfire questions. Ready for those?
I'm ready. Fire away.
Username on eToro.
It's just simply Ben Sparham, all in one word.
Date you joined eToro.
So that would be March 2020.
Date you became a popular investor.
So then that was around about August of the same year, so August around 2020.
Year of birth?
Is 1991.
Place of residence?
Is London, United Kingdom.
Profession?
So currently just full-time eToro popular investor.
Briefly state what you aim to achieve on eToro.
So looking to basically provide professional sort of guidance and information, with regards to the financial markets and the stock market.
Name one of your investing heroes.
Would have to be for me Joel Greenblatt. I think it's fantastic inspiration.
Name one of your favourite investing books.
Oh, it's got to be One Up on Wall Street by Peter Lynch. I think it's a brilliant read.
So that completes the formalities. Let's proceed into our VIP section here at the Clubhouse. The splendid Copy Traders Lounge awaits you. Ben Sparham, are you ready for this magical transition?
I'm ready. Let's go.
Okay, Ben, so here we are now in the inner sanctum of the VIP lounge. What do you make of it?
Fantastic place to be.
And normally you find yourself in London town.
Yep, that's where I've always been. So I live on the sort of outskirts of London. So I technically come in an area called Bexley, which if you want to be really particular is actually Kent. But I'm literally right on the border sort of thing. So it's just easier normally to say London. It just covers the area a lot easier.
Okay, and you worked at 3 trading companies alongside former investment bank and hedge fund traders. So you're a bit of a city boy, would that be fair to say?
Yes, my girlfriend likes to often use that phrase for me as well because I lived up there for a period of time when I was working up there. So yeah, I love being in London. I think it's a fantastic city, fantastic environment to be. You can network with fantastic individuals, and yeah, I love the place. So if you want to call me a city boy, you're more than welcome to do so.
Well, there could be worse things to call you. And now your profile picture is of a confident looking bloke in a polo shirt with folded, tattooed arms. Hairstyle is short back and sides and slick back. Would you object if someone was to say, that Ben Sparham, bit of a geezer?
Yes, you could. You could probably say that. I think sometimes maybe that. I think I definitely sound like I'm from London. I think it's fair to say. So yeah, I don't. I don't mind being tarnished with that brush, I guess.
And are you down West Ham on Saturdays?
No, I tend to avoid that. But I did used to live in Chelsea in West London. That's where one of the offices I worked at was based. And a friend of mine was a season ticket holder at Chelsea Football Club. So I used to go there quite a lot for the games. And, I enjoy football, but I don't sort of follow one team in particular. So I'm more than happy to go to a few different seasons, a few different stadiums. So you won't catch me at West Ham on a regular basis, no.
Okay, so you're from Bexley. Is that where you currently are, like living?
Yes, correct. So currently living in Bexley, yeah, and I was literally born 5 minutes up the road. So yeah, haven't gone far in that sense.
And you played golf last Friday. What did you shoot?
I shot 75.
Ooh.
I currently play off a 6. But yeah,
Wow.
golf is my kind of my hobby. I really enjoy getting out. I try to play once or twice a month. I'm actually currently preparing for a long drive competition. So like my speciality is, if you like, is I'll hit the ball a long way. But it's all for fun. I'm not looking to try and make it into the pro leagues or anything like that. I'm just looking to enjoy it, get out, have a bit of fun and make the most of the sport. And especially when the weather's nice as well. It's a perfect excuse to get outside, right?
Yeah, 76 is good shooting.
Oh, 75, Gavin. Come on. Don't
75.
knock me a score.
I didn't give you that last putt. All right, so let's talk about how I came across you.
Mm-hmm.
I assume it was through your YouTube channel. You've got a very interesting YouTube channel, which we're going to talk about in some depth later on in the chat. But I think that's where I first came across you. And to fill the listener in, there's a little bit of background about you on the website ben-sparham.com. Ben started his trading journey working at a small fund in London before operating at various other trading companies alongside former investment bankers. Having now spent over 8 years in the markets, he understands the impact these mentors had on his journey, and this is why he now helps new traders coming into the financial markets. So, I also see on your website mention of Ben's Bootcamp. What's that all about?
Yeah, so the bootcamp I sort of do here and there. There's a couple of different services basically I provide. And the idea is to allow any individual of any level to sort of try and improve their trading. So whether they're a complete beginner, they've never traded or invested before, there's like a free online course that they can do, which goes through the generic market basics just to kind of introduce things nice and easily. You've obviously got to build a foundation first, and of course work out if trading and investing actively could even be for you. Some people, when they get into it, find that it's just not for them, which is completely fine. There's obviously passive methods and stuff like that you can use. But those that then do want to take it a little bit further, there's a couple of different options. There's a full online course. So I do touch on both FX and stocks within that course. It's around about 46 videos long, so quite a few hours worth of content there. That's all based online. So the idea is that people can do it as and when they please, around work, family, etc., anywhere in the world. But then a couple of times a year, I like to do some in-person events, basically. So those would be more like bootcamp type days where we'd get together, normally hire a nice big room somewhere, have 20 to 30 people at a time, and we'd sit down and do things more on an in-person level. But of course, that would be for people that are a little bit more advanced, and we'd be discussing current market conditions, what's in the portfolio at the moment, generating new ideas, all that type of stuff. So it really does depend on sort of where individuals are within their journey, and there's different paths that they can take.
Okay, so let's get to know a little bit more about Ben Sparham when I ask you to tell us something you're very bad at.
I guess a trait that is probably both good and bad for me, and it's something that's been said to me many times across the years, is that I can be quite stubborn. So obviously there's times where that can be good, where, I will stick to the decision that I've made and I will follow through. I'm not influenced by others. But it can also be a negative as well. Sometimes I have in the past got stuck in my own ways of, very back in the very early days, I was even a little bit stubborn with a penny stock that I was holding, and it basically just went to zero. I couldn't even tell you the name now. We were talking obviously nearly 9 years ago, but there has been times where the stubbornness has been a negative, but I guess in some ways it can also be a positive. So yeah, I say that's probably a trait of mine that could definitely be looked at in both ways.
Okay, that's a very interview response, where you give an answer that is got a little bit of good as well as bad. I'm going to try again, and you have to just tell us something that you're just bad at, and there's no redeeming features.
Oh, what can I use?
What are you rubbish at? What is Ben Sparham just absolute tosh at? Pony.
Well, I'll tell you what, a random thing I could use would maybe be skiing. I've tried going on a skiing holiday before, and I was absolutely useless. There we go, we'll use that.
And how long you were there? Away for a week?
I was away for a week and ended up spending more time in the bar because I just could not pick it up for love nor money.
And after how many days of effort did you throw your skis down?
By day 3, that was it. I was like, you know what? This isn't for me. I'm better in the bar. So I went and made the most of the bar on the mountain.
Okay, let's have a question from the art of people. Can you pick a number between 1 and 10?
7.
If you weren't doing what you're doing today, what would you be doing and why?
I would say probably a sales-based role. I've done sales in the past when, the account management roles and stuff I've had previously obviously have a sales element to it. And the reason for that being is that I love communicating with people. And I believe a good sale of any product or service is one where there's fair exchange, i.e. the individual's getting good value out of the service or product provided. And that comes from finding out a lot about that person. So, finding out their wants and needs, why they want to use that particular product or service, etc. So for me, I find that very intriguing, getting to know an individual. So that, becomes an enjoyable part of that type of job or career.
All right, Ben, let's get a little bit into your eToro profile now. If I could ask you to read from your bio, can you read the 2 sections, my goal and strategy?
Of course. So the goal for myself is to outperform the benchmark on a risk-adjusted basis long term. And then the strategy is a diverse portfolio designed to reduce risk and volatility while providing solid returns. Half of the portfolio is invested in individual stocks that I believe to be undervalued, while the other half is allocated to a multi-asset selection of ETFs.
Right. And the next line then is, if you want a low risk and consistent portfolio, this is perfect for you. So that's quite clear. I think 2 of your main tenets are low risk and valuation matters. That's a point that you come back to again and again.
Yes, 100%. That's what I'm looking for. I'm looking for, think of it like a smooth equity curve over time rather than chasing big gains, but then the potential for large drawdowns. It just suits me more as an individual to have a less volatile portfolio, basically.
Okay, so this is more or less the bio section of the conversation. It'll be followed by the portfolio section where we'll go deeper on all of that stuff. For now, let's have a quick look at your overall results. Now, a look at your monthly bar chart. paints a very unusual picture. You dipped your toe into eToro for 1 month in 2014 and then disappeared for 6 years before returning again in March 2020. What was going on there?
So that would have been in the sort of earlier days of me getting into sort of trading and investing. I was basically testing out different platforms and actually testing out the copy trading. Put a very, very small amount of money back in 2014, just only had it in there for a month. And in all honesty, didn't really know how to use the platform properly and stuff like that. As I say, very, very early days of my investing journey. So it was then just a case of I just simply wasn't using the platform. I was using other platforms and stuff like that. And then obviously came back to the platform in 2020, hence the reason there's that gap there.
Did you go to sign up for eToro and realize you already had an account?
No, I knew I had a profile already. So obviously, it just simply a case of forgot my password, get a new password generated so I can sign back in again, and use the account I already had. So I did know that I already had one. And of course, because eToro tracks everything, which is of course is a very, very good feature of eToro as a platform. It just meant that there was that gap there in the track record.
Well, that's what happened to me is when I came to sign up for eToro, it became clear I already had an account and I had no idea. You know the way you sign up for these things left, right and center and you kind of lose track of what's what.
Yeah, I think it's easy to do, especially maybe when you're first starting out or something like that, or you just maybe want to test a platform and just kind of compare, depending on your wants and needs and stuff like that. So I think it's probably quite a common thing for most people to do, in all honesty.
Okay, so let's talk about your risk score. Aside from a few months where your average risk score jumps up to 4, and in very recent times your max risk has been 5, the standard story is of you being pretty much a risk score 3. That's the way you like to keep it?
Yes, exactly that. So my typical risk score will generally sit around about 3. Obviously, with the recent increase in market volatility and stuff like that, and obviously the way that eToro has been trying to be very strict with how they're managing people's risk profile, basically, has just nudged up slightly higher to sort of sitting an average of 4 with a peak of 5. But I think that is also testament to the low risk style that I use, that even in these current conditions, it's still only gone up to sort of 4 and 5. Typically, as you stated there, it does sit more around the figure of 3. So yeah, very much an emphasis on being sort of low risk consistently, basically.
Copier numbers and assets under copy. Now, you have a website, you have a YouTube channel, and a training program, paints a picture of professionalism. If someone was to look at just those things and then look at your eToro profile, I think they'd be surprised to see 47 copiers as opposed to 1,000. Do you think you're criminally underappreciated so far on eToro?
Yeah, in certain respects, I would say so. I guess maybe part of that I'd say it's probably a twofold thing, really. I'd say one part of it being that a lot of people come to me to learn how to trade and invest themselves. So obviously they then go off and predominantly build a portfolio of their own, which is obviously fantastic to see. The other side of it will probably be because my investing style, I don't tend to chase the big names or the names that are necessarily popular. I'm looking for more undervalued businesses and stuff like that. And of course, it is more towards a low risk style. So the standard deviation in my portfolio is quite low. So I don't have necessarily those big years or big, months that necessarily would outperform or kind of really catch people's attention. So I guess maybe that has, something to do with it. That some people are looking for those bigger returns, and I'm never going to necessarily come up on someone's radar for something like that. So unless you are looking for that lower risk, consistent kind of style, I'm probably not really going to flood up on so many people's, sort of radars, basically. So that's probably part of the reason as well.
Do you think that recent market fluctuations are going to change that landscape a little bit?
I think we could definitely see that. I think there are a lot of people that have probably only been in the markets for the last couple of years since we had, what went on with COVID. especially in March and April time of 2020. We saw that large decline in the market. And obviously since then, this huge rally that we've had, it's almost been a bit of a case of, almost anybody could make money doing anything. And it's that old adage of everyone's a genius in a bull market, right? So there's been plenty of people that have had these big gains, maybe thinking that that is the norm in the market. And then when we've seen markets correct, S&P currently down around 15% or so from its highs at the time of recording this. The NASDAQ, being a little bit more than that. We've obviously then got certain names, the likes of Square, Snapchat, companies like this that you could argue were very overvalued previously, have had much larger declines than that. And of course, if you've got a portfolio made up of those names, you're seeing some heavy drawdowns at the moment. So, it's probably going to be a little bit more of an emphasis on some lower risk, on some valuation because of the climate that we're in 100%.
So have you been bathing in growth investor tears over the past 6 months?
Look, nobody ever likes to see anyone lose money, right? But there is also an element of, I try and always keep it very real on my, YouTube videos, and probably maybe part of the reason why I don't get as many views on there as certain channels do, because I'm not, hyping up the Palantirs or certain names which everyone wants to seem to want to own because they're going to go to the moon and all that type of stuff. But, there is an element of, without sounding, too sort of much like you're having a dig at them, of a little bit of I told you so type thing. If a company's trading at crazy valuations and pricing in all sorts of growth, quite frankly, it can't stay like that forever, right? So there has to be a little bit of realism in somebody's portfolio and investing style. And I think at the moment it is a little bit of a reality check for some people, unfortunately, but that is just the reality of the market, right?
Okay, trades per week and average holding time. Trades per week, 3.35. Average holding time, 3.5 months. What do you think of those stats?
To be honest with you, they're probably slightly skewed. So my typical holding period for a company is, generally speaking, 12 months or maybe a little bit longer. But because there will be some rebalancing in my portfolio, so for example, the ETF portion of my portfolio, there'll be rebalancing depending on how certain asset classes have performed, obviously partially closing positions and adding to certain assets and stuff like that. It will slightly skew those figures to make it look like I'm a little bit more active than what I actually am. So the main rebalancing will come at the beginning of each year, typically speaking for me. But then depending on how particular holdings have performed, there may be some rebalancing throughout the year. So the holding period is actually more towards the sort of 12-month time frame rather than the 3. It's, like I say, just a little bit skewed because of those rebalancings that take place.
Okay, going back to your website, it also says this. Ben predominantly trades stocks and Forex. He applies a swing method to his trading, looking to capture larger moves for an increased reward to risk ratio. His open and transparent style is perfect for both new and experienced traders to learn from. So that doesn't define your eToro activity, really.
Well, I guess it's more of a generic kind of, about me on the website sort of thing. So in all honesty, I don't actually trade FX as much nowadays. I am becoming less and less active just simply because I don't spend as much time in front of the computer. But if you look back at, say, if you'd have spoken to me, say, 5 years ago, for example, I was more actively managing, positions within FX, typically holding those for a few weeks or a few months at a time, things like that. So, I believe everybody always slowly, transitions and progresses as an investor, depending on, what's going on in your life, whether that be on personal, family matters, work, whatever it may be. Everyone always develops and changes slightly as a trader and investor. And for me, it's just that I'm becoming less and less active, I guess you could say. The older I get, it just suits me personally better now than it did, say, 5 years ago. So just making that slow transition, I guess you could say.
Okay, because I was wondering, is there maybe like a dichotomy between what happens on BenSparham.com and how you teach people compared to what you do on eToro? But it's kind of consistent. The message is consistent. The activity is actually quite consistent, you would say? Yeah.
Obviously, if somebody goes through my training programs, I will teach them the methods that I've used within the FX markets. It's just a case of where I'm at within my life now. I don't actively trade FX quite as much. That's all it is. But in terms of, holding stock positions for longer period of time, that's always been the case. And so therefore, yeah, it is very much consistent across the board. It's just in terms of how active I am nowadays has just changed slightly. That's all.
You're not going to do an Olivier Danvel and move from FX to becoming a crypto billionaire?
No, there won't be any of that taking place. Look, my views on crypto, won't get into it too much, but I believe the asset class is definitely going to stay. But I think at the end of the day, you have to stick with what you know. You can't become that jack of all trades, master of none type scenario. You're never going to understand everything. Like, for example, I don't trade options. Doesn't mean that I can't make money in the markets because I don't understand options and futures particularly, well and in a huge amount of depth. That's just not my circle of competence. Warren Buffett talks about that all the time, doesn't he? So I think it's one of those things that if it's just not within your sort of wheelhouse, basically, just, let other individuals deal with that. And for me, I'm not going to go chasing the latest, hottest trend or anything like that. I'm going to stick with what I know, what I understand, and what can produce me the results long term, ultimately.
All right, Ben, permit us a little glance behind the curtain, if you will, by telling us, what does your watch list look like on eToro?
So my watch list is literally on eToro, in terms of what I've got selected on the watch list, is literally just the S&P, the NASDAQ, and the Dow Jones. And it's just simply to basically be keeping up with how those markets are performing as a bit of a measure of the overall market consensus and how I'm performing in relation to that. I'm quite a systematic investor, so it's not a case of I have a bunch of stocks on a watch list and I'm waiting for this to happen or for that to happen within the business. It's very data driven. So on a weekly basis, I'll run particular screeners, and if there's certain things that are popping up, they will obviously get added to potential sort of things that I want to look into. But it's not a case of I have a long list of stocks or potential trade ideas that are sitting ready to go, basically.
Okay, so let's move on to your communication and talk about your YouTube channel now. You have a very professional looking opening to all of your videos, like opening credits, a series of colorful graphics with stock charts, Wall Street, a Ferrari, a boat, and a private jet in the kind of animated motion style reminiscent of the opening sequence of Have I Got News for You? A TV show that some listeners might be aware of. And it's accompanied by a sax-heavy, funky theme tune that goes that goes a little something like this. Did you make that opening sequence yourself?
I can't take credit for that. I've got a friend of mine that's a web developer, builds websites, works with various brands up London. And I was fortunate enough to be able to steal a little bit of his time, and he put that together for me. So a little bit of guidance from myself, and off he went, and he put that together for me to make the intro a little bit more fun rather than having it too bland and just a logo or anything like that. I wanted to keep it light and keep it fun. So you mentioned there, obviously, the Have I Got News for You? Whilst it is a program that I enjoy to watch, it wasn't a source of inspiration. It was actually a couple of different YouTube channels that I've seen have got like a similar-ish kind of style in terms of it being animated and stuff like that. And I thought they were quite fun and light sort of intro style. So I took a little bit of inspiration from them, and it just so happens that it turns out to be kind of similar to Have I Got News for You at the same time. But, it's a light, fun program, which I'm sure a few of the listeners have watched over the years. So I'm sure they'll have happy and fond memories of that program as well.
And your YouTube channel is very active. You do mostly stock analysis, but other subjects too. You seem to be producing like 2 or 3 videos a week. Is that right?
Yeah, so I try to post a video pretty much, on average every other day, essentially. But of course, depending on my personal schedule and stuff like that, sometimes there'll be 3 or 4 days I might post in a row, and then there's a 3 or 4 day gap or something like this. But I try and be pretty consistent and pretty, up to date as well. So if a company's had sort of particular earnings or something like this, and there's a good reason why we want to obviously cover that particular company, it's obviously makes sense to do that, as close to those earnings releases or particular piece of news has come out. And I just try to keep as active as possible, because I feel, anyone that watches my videos on a regular basis, it obviously keeps them in the loop basically with what's going on with particular companies, and and just giving them my thoughts, basically. At the end of the day, there's no financial advice and people can do whatever they want to do. It's not to say if I believe a company's overpriced or underpriced, it's going to, the stock price is going to move in a particular way. It's just simply a case of I'm just like, and I like to, share my views. I enjoy making those videos. So it's as much of me enjoying it as much as trying to obviously pass on that information and for the viewer to take something from it as well.
Yeah, we're going to get into the content of the videos on your YouTube channel in the portfolio section, because I think it's interesting to explore the extent to which your YouTube channel does and does not reflect your eToro activity.
Sounds good to me. Let's get into it.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Okay, Ben, let's turn our attention to your portfolio now. I'll give the listener a bit of a broad brush description. Starting with asset class allocation. As you mentioned earlier, it's not a difficult one to grasp. Stocks 50%, ETFs 50%. Couldn't be easier.
Couldn't be easier. Keep it pretty simple. So, one half of the portfolio for individual names, the other half for ETFs, which has some stock allocation in terms of equities, but also bonds, commodities, and gold, etc.
Yes, you have 30 stocks and you have 6 ETFs. Of those 6 ETFs, 5 are your top 5 positions. And they are TLT, 20-plus year Treasury bond, VTI, the Vanguard Total Stock Market Index, IEF, the 7 to 10 year Treasury bond, GLD, gold, and DJP, which is a commodity index ETN, including energy and precious metals and grains and various other commodities. So, those kind of instruments some people might consider to be hedges in their own portfolio, but together, as a block, they constitute the backbone of yours. You think that's accurate? And tell us why that is.
Yeah, exactly that. So essentially what this model is and the ETF selection and balance is aimed towards is very much around the all-weather portfolio that Ray Dalio famously introduced in the late 90s and actually has a fund now set up for that. And the idea of this allocation is basically that we have the economy essentially goes through 4 main different conditions. So economic growth, economic slowdown. We have inflationary conditions and we have deflationary conditions, which obviously we've experienced the inflationary side of recently, right? And essentially what we have is that money doesn't obviously vanish. It simply transfers. Okay, we often hear that sort of phrase that money sort of transitions rather than vanishing. And basically what that suggests is that in certain economic conditions, particular asset classes will do better or worse. So, for example, if we have inflationary conditions like we've had recently, typically commodities and gold and stuff like that tends to do well. So we get that flow of money from one asset class to the other. And the idea here is that we're essentially getting 25% allocation into each of those 4 compartments, if you want to call it that, different conditions. But of course, different asset classes move differently. Stocks, for example, are typically roughly 2 times more volatile than bonds would be. So, of course, if you had exactly 25% weighting to each, it isn't actually evenly weighted, if that makes sense, right? Because the volatility would, take the weighting across. So we have different allocations and it is volatility adjusted to ensure that the actual allocation is in a true reflection of 25% to each asset class. So, for example, if you were to simply just take the ETFs and just have that 100% as your portfolio, the weighting would actually work out that 30% of that would be VTI, which is, of course, a total stock market ETF. So, i.e., that's your equity exposure. You'd then have 40% to the long-term treasuries. You'd have 15% to medium-term treasuries. So you're getting different duration lengths there, which obviously will perform different in different conditions. And then you have 7.5% to gold and 7.5% to then the DJP, which is a basket of commodities, as you correctly pointed out earlier on. So that essentially acts as your best risk to reward ratio profile that you could actually build in terms of when you look at Sharpe ratios and stuff like that, because it's going to produce the lowest volatility for the type of return that you're actually getting. And of course, somebody like Dadio has back tested this pretty much as far back as you can possibly go, in time. So going through world wars and various different recessions and economic conditions. So it's been very, very well stress tested. So for me, that acts as the backbone of the portfolio by having half of the capital allocated to that. But then obviously I want to have some individual name exposure as well to essentially try and achieve some alpha on top of that, i.e. the outperformance element. But of course, by having that ETF as the backbone, the ETF selection as the backbone, it creates that balance between the lower risk when the market is a little bit more rocky during more volatile times like we're seeing at the moment. It doesn't allow it to be too, swayed, if you will. But at the same time, by having some exposure to more concentrated, individual names within the portfolio, it also allows that, in good quality times for equities, and when we do have, bullish periods, we can also, achieve that upside. So it creates that real nice balance, and a balance that I personally feel very comfortable with. Some people, some students of mine, for example, have a slightly bigger portion of their portfolio towards the ETF selection. Some of them have a slightly smaller allocation to the ETF portfolio. So it all really depends on what your risk tolerance is, your investment goals are. But for me, that 50-50 balance works best.
Okay, and what that means is that over a quarter of your portfolio is in bonds, generally considered to be a buffer against down markets, because there's only been a handful of years when bonds returned a negative figure. And a really bad year for bonds is never anything as bad as a really bad year for stocks. So these on their own provide usually modest gains, I think it's fair to say. Mm-hmm. Now, in a rising interest rate, bonds normally go down, at least in the short term, everybody says. Are you keeping the faith with such a large bond allocation in this environment?
Yeah, so I'm not somebody that believes too much in market timing. I think what some people try and do is they try and predict the future a little bit too much, and they start to shift the portfolio too heavily weighted, for or against particular asset classes. For me, I would rather keep the even balance. And of course, if we do have a period where a particular asset class does underperform, we're typically finding then such things such as commodities, gold, and asset classes such as that are obviously benefiting at the moment. So the idea of an allocation such as this and an all-weather style allocation is that you're not trying to predict what the best asset class will be. You're creating that even balance. And if there is an area of underperformance, there's typically some overperformance elsewhere and vice versa. So for me, it's a case of making sure that weighting's kept, and that's where the rebalancing would come in from time to time, making sure the balance is there and the weighting is there correctly in each asset class as we move forward. And then my job is not to try and pick when the particular economic conditions may change from one to the other. It's letting the portfolio weighting and balancing do the job for me, if that makes sense.
It does, yes. And isn't it also the case that because you're invested in bond index funds, these index funds, not the bonds themselves, but the index will over time rebalance into new bonds with higher coupons that'll lead to positive long-term performance because they are managed?
Yes, exactly that. So there is also that element to it as well. So it basically provides me the most efficient way, I guess you could say, of having that exposure. And of course, I'm not applying leverage or anything like that. It's giving a nice, simple allocation to that area and to that asset class. And then, like you say, it's rebalancing it in the most healthy way possible, basically.
Everybody says normally stocks and bonds don't go down together. Have you been surprised by bond performance in recent months?
Within reason. I think to the extent of the decline in the bond market has been a little bit of a surprise, but it's not a surprise that it has headed that way as a whole. So it's not a surprise that we've obviously seen a negative move within bonds. Well, obviously yields going up, but the bonds that you own obviously going down. It's just obviously a product of a very unique kind of situation that we've got, right? So we've obviously had inflation going through the roof. We've come off the back of the situation with COVID and creating a very, I guess a lot of people would argue, a very propped up economy with the amount of money that's been printed and pumped into the market by the Fed, etc. So, it is quite a unique cocktail that we've got, and the Fed are obviously in a position where, probably the best way of them, producing things going forward or creating a balance, I should say, going forward would be for them to raise rates, which of course is then, hitting bonds. So it's not a complete surprise in terms of the direction of the market, but it maybe could be a little bit of a surprise to the extent that bonds that have been hit.
Okay, so half of your portfolio is in those ETFs, which constitute mostly bonds and commodities, but also some stock exposure, as you say. Then if we look at what the other half of your portfolio consists of, what we don't see is a load of speculative growth stocks. I see themes like energy, steel, logistics, construction, food, clothes. It struck me that if Bear Grylls was a PI, his portfolio would look like yours. Got to stay warm and dry, build your shelter, get some sustenance.
He'd probably be a copier of mine, I would say. But yeah, no, it's, the individual stock allocation that I have is very much focused, as we briefly touched on earlier on, the valuation aspect. So I've been fortunate enough to learn from, a variety of individuals, in person from the places that I've worked in the past, but also from an extensive amount of studying that I've done myself. And the style that just resonates with me and for me is completely logical is, Joe Greenblatt sums it up very, very simply in that investing is simply working out what something is worth and then paying less for it. And that applies to anything, whether it be a home or stocks or anything that you're investing in. You're trying to work out what that asset that you're buying is worth and then paying less for it. And that's how you're going to make, obviously, the best return on it, but also by doing so in the lowest risk manner possible, basically, because you're building in what Benjamin Graham refers to as a margin of safety, right? Because nobody knows exactly what's going to happen in the future going forward. But if we've paid a fair price for that particular asset, whether it be a stock or whatever it is that we're purchasing, even if we're wrong about the future, we shouldn't get hit so hard. Whereas this is what we're finding, obviously, with a lot of growth stocks at the moment. They were very dependent on what the future could be and how this company is going to do X, Y, Z. But then when the conditions change that obviously put a big dent in that potential plan going forward, the panic sets in and the stocks get dumped. This is why we're seeing certain names having drops of 60, 70, 80, potentially even more % in certain names because, we're really kind of ruining the future and everything was dependent on the future. If you can own a business to start with that's got sensible debt levels, for example, good amount of cash on the balance sheet, is cash flow positive, makes a profit. Yes, there's no way of knowing exactly what's going to happen going forward for that company, but any kind of future that we're looking at is obviously already based around a solid business rather than a speculation on what that business could be. So for me, that is just very logical way of investing. And at the moment, the types of names that have been a little bit out of favor, so therefore the stock prices have obviously been depressed a little bit relative to the sort of businesses that we've got, obviously some energy names and things like that, which are obviously now starting to do quite nicely in the current conditions. But of course, if you was to fast forward 24 months, there could be a completely different variety of companies in there because a different sector may have been a little bit out of favor. Certain stock prices have obviously been depressed a little bit there, but there could be some really great businesses within those sectors that could then benefit going forward. So for me, it's just a very logical way of investing to try and find a good quality business that generates a profit, hasn't got a ton of debt, and has essentially already got a foundation in place rather than just trying to guess what might happen in the next 3 to 5 years within the latest, funky sector that's everyone's got everyone's attention, basically.
Yes, valuation and fundamentals are obviously very key to what you're all about. But the names I'm seeing in the stock half of your portfolio are very much in keeping with that kind of all-weather approach that you talked about earlier. You're not gambling on whether a certain trend will grow over the next few years. You're not sitting there rubbing your chin on what the future might look like. You're saying this is the stuff human beings need today and will need next year and next century. So it strikes me you're more of a grounded realist than a futurist. You'd rather make a few % from solid, established, common or garden industries than trying to chase those big returns based on how you predict some hipster in San Francisco is going to commute to work 2040.
100%. I would completely agree with that. For me, again, like I say, it comes back in line with that very logical way of looking at things, right? It's impossible for me to know what the latest trend is going to be in 5 years' time. As you said, the new business that somebody's come up with in San Francisco or wherever the tech hub may be in the future, right? So for me, I look at it and go, why try and predict a future that isn't completely knowable when I can look at what the reality is now and then sit there and say, right, well, this is a fact. This isn't me trying to predict. This is a fact. And how does the valuation of this business that I understand right now, how does a valuation then match up to that? There'll be particular companies that are very much in the same sectors of the names that I hold that I'm not owning because the valuation doesn't match up. So it's very much what you could describe as a bottom-up approach. It's understanding the business first, making sure the numbers make sense, the valuations make sense, and saying, right, I believe this company is fair valued at X. How is the market currently valuing that? Okay, the market is currently asking a little bit more than what I would be willing to pay for that business. So at the moment, I'm going to sit on the sidelines. However, if the stock market is basically offering me a price that is less than what I believe that business to be worth, well, then to me, that looks like a potential investment opportunity. And that's when we look to kind of take things going forward, basically. So quite systematic and quite data-driven. And I guess, like I say, you could probably class it as more of a bottom-up approach rather than a top-down approach and looking at the macro events and stuff like that.
Okay, so in some sense, you're not really playing the same game as a lot of big-name PIs on eToro, or certainly those that have been big names over the past few years, because they're, to a large extent, growth investors. So that begs the question, what sort of returns are you looking for? And if we can go back to your bio, you said in your bio to outperform the benchmark on a risk-adjusted basis long-term. What is your benchmark?
So I look at the S&P 500. I know certain people, if they are more value-based, may look at certain value indexes, or if they look at a broader universe of stocks, they may compare to, say, like the Russell 2000 and Russell 3000, if they're looking at a wider range, depending on market caps, etc., they're focused on. For me, I just think the S&P 500 is the best broad metric to look at, because obviously I'm predominantly investing in US companies. So for me, that's the measure I typically look at. Now, I think what people sometimes maybe don't understand is that there's two different ways of looking at outperformance. So a lot of people, if you say to outperform, a lot of people presume that you've made a higher percentage return, right? So i.e., if we just use a simple example, the S&P made 10%, did you make more than 10% that year, right? That's just kind of very black and white in how they look at it. But there's other ways of looking at outperformance, which also then factors into the risk profile of something or the standard deviation and things like that. So, for example, if two investors both make 10% in any given year, but one of them has a higher risk profile, one of them has a higher standard deviation, i.e. the volatility within the portfolio is having bigger swings, I would look at the investor that made 10% with the lower risk and with the lower volatility within the portfolio as the better performance. So that's where you get what's referred to as alpha. So your beta is essentially your baseline performance. So if we use the S&P, we could use that as our beta, because you could say, well, you could go and invest in an index fund or an ETF that tracks the S&P, and that's kind of your bottom line performance, right? So that could be looked at as your beta. Your alpha, in terms of your outperformance, could then come from achieving the same return but reducing your risk. So your Sharpe ratio would obviously then be higher than the market, or of course, standard just outperformance in terms of making a higher percentage return. So for me, I look at it and I say, right, if over any given 5 to 10 year time horizon, if I can match, obviously ideally outperform, but the baseline sort of target and goal is to match what the market has achieved. But if I do so with lower volatility in my portfolio, with lower risk in my portfolio and a higher efficiency rating, i.e. my Sharpe ratio in the portfolio is higher, if I can do that, that for me is my outperformance, because I'm not looking to chase those big wild gains like we say, some people do. And it's not to say that my investing approach is necessarily better than the next person's. It just suits me personally better and what I'm looking to achieve. I don't want to look at my portfolio one day and have a 50% drawdown. I'm always going to do the most I can to avoid that, right? So if I can sit there and say, prime example being this year, the NASDAQ at one point was down nearly 30%. The S&P has obviously touched that 20% sort of bear market threshold. The most I've been down at any one point is around about 14.5%. And we're currently sitting at the time of making this at about minus 9.5% for the year. So that to me is I sit there and say, well, my portfolio is achieving exactly what I want it to do. During market corrections and down periods of the market, I'm not having these huge swings to the downside. Obviously, what comes hand in hand with that is I'm not going to have the massive swings to the upside. But if I have the most efficient, smoothed equity curve within the middle, basically, trying to get the best of both worlds, that to me will be my outperformance. And that's how I'm going to measure myself over the next 5, 10, 15, and 20 years going forward.
Just a little breather here to let you know that soon I will be making some episodes exclusively available to supporters of the show. As a thank you to those who've already signed up on patreon.com/copytradersclub and to encourage you to take the plunge. This will become more of a feature. Episode 20 will be a solo episode discussing whether eToro and the world of copy trading is perhaps much smaller than you think. We will consider what might be going on with the SPAC and whether eToro is making any money. And also why my faith in eToro is shaken and what I would suggest they could do to build trust, the essential component for any financial institution. That's all coming out on episode 20 on the 17th of June, only for supporters of the show who contribute a mere $3 a month, the price of one cup of coffee. Future episodes this season with returning high-profile PIs will also be exclusively for supporters of the show. I plan to drag some big names back in and ask them tricky questions like why they've done so badly and upset their copiers, and even whether they deserve to be at their salary level. So an increasing amount of content will become for supporters only. You can do the right thing and join that exclusive club today. patreon.com/copytradersclub. Now back to the show. Now, having said all that we said earlier about the kind of stocks that you buy in eToro, I would say there's a big dichotomy between those stocks that you buy in eToro and those that you make videos about.
Mm-hmm.
Here's a sample of your YouTube playlist. Palantir, Snapchat, Nike, Peloton, PayPal, AMD, HP, Google, Tesla, Netflix, Alibaba, eBay, Starbucks. You get the picture.
Yep.
I had to scroll a long way down to find a video about something that's in your portfolio.
Mm-hmm.
And that's when I came across Dick's. You made a video all about Dick's.
Mm-hmm. Dick's Sporting Goods.
Sorry?
Dick's Sporting Goods. Probably best to finish that name.
Well, then you'd leave me no scope for sexual innuendo. I was going to say you have a fondness for Dick's. Or to rehash a joke from a previous episode, good to see you putting your money where your mouth is.
Brilliant.
So if I was your copier on eToro, or if I was even interested in copying you on eToro, and I went to your YouTube channel, it is very interesting to watch videos about stocks that you don't want to buy. That is very interesting. You learn a lot from that, and that is kind of the theme of many of your videos. Here's a company that everyone's talking about. Is it a good buy today? Skip to the end. No, it's not. It's still overpriced, right?
Yeah.
But if I was your copier, I'd also want to see videos about all the things that are in eToro. A video on why you're interested in bonds, why is half the portfolio in ETFs, why is your portfolio holding up quite well in this market, a stock analysis for something you did buy, such as Tyson Foods or Whirlpool or POSCO. These are the kind of names that are in your portfolio, and why you think they're good investments. Mm-hmm. And also a video about why all your stock positions are the same size. Those are the kind of things I'd love to see that would speak to me as your copier or potential copier. Do you understand what I'm getting at?
Yeah, 100%. To be honest with you, when it comes to the YouTube side of things and making the videos there, it's obviously a lot of it is quite often what you find is you've got some newer traders and investors, right, that will be on YouTube. Of course, you get a variety of experience levels, but I would say the bigger portion is probably more slightly newer individuals. So of course, what they tend to do is it tends to be a case of names they know, the Nikes, the Netflix, the Googles, understanding a little bit more about them, or should I buy this stock because I buy this product kind of thing. So quite often they're the sort of names that most people are looking at. So from a valuation aspect, I'm trying to help people understand just because you know these names and just because they've done well in the past doesn't mean you should buy this stock now. Yes, Warren Buffett's held Coca-Cola for years and most people drink it on a daily basis, and it's been a phenomenal return for him and he makes hundreds of millions a year from dividends XYZ, but that doesn't mean that you should now go and buy it today. He bought that stock back in 1987 or whatever it was when he took his full position and so on. So it's about helping people understand why just because a company is a big name and a name you might be familiar with, it may be on trend for whatever particular reason, doesn't mean that it should be an investment, and helping to understand what price that company could be a potential investment at, especially in a market the way we've had, the general market itself becoming quite overvalued by various different metrics. I think the sometimes the hard thing from a YouTube aspect is if I go and make a video on Olin Corp, for example, 99% of people aren't going to watch that. They've never heard the company before. They're not going to understand it. So it can be quite difficult at times, in all honesty. And I think maybe that's why I've got slightly lower subscriber base and stuff like that compared to some channels. I think some channels like to pretty much just tell the viewer what they want to hear. What's the hottest stock at the moment? And this stock's going to do this, and Tesla's going to go to 1 million and all sorts of stuff. But for me, that's not what it's about. I'd rather have a smaller audience go through real analysis and help people understand, because I think it's just as important to understand why you shouldn't own something as to why you should. And then people can really start to kind of make that, comparison and really kind of define what does make a good investment and what doesn't make a good investment. If you're owning a stock that's already overpriced, yes, that could do very well over the next 12 to 24 months. But the probability side of things would say it's more likely to underperform the market. And if you're taking on individual business risk, i.e. you're buying an individual name rather than investing in the index, you're taking on individual risk because you're exposed to how that one company performs, there needs to be the potential to outperform the market, right? What's the point in me owning an individual company name if it's probability-wise not going to outperform the index? So I've taken on additional risk for potential lower returns. So it's trying to find that balance. And in all honesty, it's quite difficult to do on a YouTube channel, in my experience anyway. There are some channels out there that will just go and basically tell people what they want to hear. I'm not going to name names, but like you see certain channels, saying Tesla's going to $10,000 a share. And in the next video, they tell you how they've dumped all their Tesla stock because they think the market might pull back. There's just conflicting messages. But unfortunately, channels like that, they've got like 1 million subscribers and they get all the views and stuff like this. It's just unfortunately the world that we live in. I try and keep a best balance as possible because obviously you're trying to educate people in both ways. And maybe I could do a better job of trying to create a healthier balance. But that's kind of really my aim there, is to try and also show people that just because this is a brand name, it's done well in the market over the last 20, 30 years or whatever it may be. This is why it shouldn't necessarily be an investment for you now, because I feel like they're just as important to understand as, why you should own something. So hopefully that makes sense.
It makes sense. But the question about balance that I'm trying to get at is the balance between being a YouTuber on one side and on the other side, being a popular investor, making videos for your eToro audience.
Mm-hmm.
I really like your videos. I think they're very informative. I enjoy watching them. But as I say, if I was your copier, I'd like to see some that are a bit more specific to what I'm holding through you.
No, that definitely makes sense. And to be honest with you, I definitely take that on board. I think that could be maybe something I make more of a point of going forward. I try and do like quarterly reviews as well, so for people to understand the performance and why the portfolio is balanced in a particular way. But of course, that's only going to be 4 times a year, right? So yeah, I mean, that's definitely probably something that I will take on board and definitely, look to do more of going forward. I think that's some actually really positive and really good feedback from you there, in all honesty. And if anyone's ever, anyone that's listening to this, if they ever watch my YouTube videos and they've got a particular company they'd like me to analyze and things like that, please do feel free to chuck a comment underneath and let me know. And I'll always try and get round to that. Obviously, I've got a community as well, and I get suggestions from those guys in the subscription base. So I try and create as healthy balance as possible. Maybe not, going to be perfect, but I'm trying to deal with requests and, trying to create that balance. But maybe there's more that I can do from a what's in my portfolio type of angle, if that makes sense. Yeah, I definitely see what you're saying there.
Also on your YouTube channel, I see episodes of a podcast called Traders Corner that you did with everyone's favourite Irish commentator on eToro, Henry Ward, where you seem to discuss maybe some more short-term trading on all sorts of stocks that, again, wouldn't make it into your portfolio. Tell us about that podcast.
Yeah, so we haven't actually done an episode of that for a little while, to be honest with you. So Henry's actually a friend of mine. I've known Henry for a number of years now. And so we started making a few videos together sort of on a weekly basis, just basically discussing hot topics. So if there's a particular thing that's gone on that week and that's relevant, because of course, people that are coming into the market, they'll be seeing these types of news headlines on company X and this company's doing this and this is what's going on this week. So we're trying to keep that as up to date as possible in terms of market news and topics that are relevant to the time, basically. So it isn't something that we've actually done for a little while. It's probably pushing on a year now, maybe, since we last done an episode of Traders Corner. It's just been a case of basically schedules haven't aligned as well over the last 12 months. But it's actually something that we've discussed recently doing again, trying to get in at least maybe once a month or something like that, just to sort of help people as much as possible. At the end of the day, we're just trying to provide as much value as it's possible to do within the hours in the day that we have to obviously be able to put towards that. So it is something that maybe we'll do again in the future. But yeah, they were very kind of on topic for what's going on and news related to that week when the times that we was making them.
Okay, let's talk about desync within your portfolio. There's not much desync. Where it does exist, it's in the stock positions, which are all small. So the effect is very limited. I'm not sure if I mentioned this earlier, but you have 30 stock positions and they're all exactly the same size. They each constitute 1.65% of your invested amount. Can you give us the rationale behind that?
Yeah, so as I mentioned earlier on, it's quite a systematic approach that I use. So if anyone's ever read books such as The Magic Formula, The Acquirer's Multiple, Deep Value Investing as well by Tobias Carlyle, and any kind of systematic approach and where you're holding a basket of stocks is typically a case of equal weighting. Think of it, I guess, probably the easiest way of maybe thinking of this is imagine when if you're creating your own ETF, essentially, right? So it's not a case if you believe one company in there is better than another, so you want to have a larger weighting to that particular company or anything like this. It's about having an equal balance. And what you're looking for is that portion of stocks that you own or that basket of stocks, those 30 stocks in the portfolio. You're not looking at individual performance so much. You're looking at how they perform as a basket. So I guess, like I say, the easiest way of probably thinking of it is almost as if you're creating your own mini ETF with select names in there based on the particular metrics that you're looking for. You could maybe describe it as quite a quantitative approach, although obviously there's no algorithms and stuff like that involved. It's very much manually executed, but it's very systemized in the way the selection process is done, very data-driven, looking at particular metrics that we sort of half touched on earlier on, and then making sure we've got equal weighting to those names, and we're looking at that as an overall performance of the group rather than individual names in there. So we're not, like for example, if you look at a Warren Buffett, it's got a heavy weighting towards Apple, and then certain other names within the portfolio have particular weightings and so on. For me, it's very much looking at the whole basket's performance rather than concentrated focus, basically.
Is that not difficult when you have different levels of conviction over specific positions?
Well, for me, it's not so much of having different levels of conviction because, like I say, where it is very systematic in how those stocks have been selected, I don't sit there and think, well, I believe this company here will outperform this company. There's not too much, So your analysis style was essentially either quantitative or qualitative, right? So your quantitative will be very data-driven, looking at the numbers, certain multiples and metrics that you may look at. The qualitative aspect would come into, going through a quarterly report, the annual reports, getting to understand the management of a business, etc. Where this is a very much systematic approach, it's not that I'm sitting there saying, right, I believe Zim will outperform Olin Corp, for example, because of XYZ. I'm just picking those names based on the certain data and metrics that I look for and creating that basket. So because it is very systemized, it's not that I have more conviction in one name than the other. One of the names might have a huge 120% gain that year. The other one might have a 30% decline. But if you asked me at the beginning of the year which one I thought would do which, I wouldn't be able to tell you because they're selected on a very quantitative basis.
Okay, let's turn our attention to your copiers and your would-be copiers, Ben.
Mm-hmm.
In a nutshell, who should copy Ben Sparham?
For me, I think someone that's looking to diversify their portfolio in a more low-risk manner. We've discussed it a few times today that is very much a theme of my investing approach. So whether that be a case of someone's got a few different copiers in their name and, in their portfolio, and they're looking to kind of split up because maybe one of the people they copy is more growth-based, for example, and they're looking to obviously have a slightly different approach in there, or whether it be a case of they're just looking to split up their own portfolio and they want to have a more, I've got certain copiers, for example, that I know have, say, 20% of their portfolio of cash that they just play with and, take individual trades and individual companies and a bit more speculative with, I guess you could say. And the copying of me creates more of the foundation of their portfolio. So really and truly, I think it's more a case of understanding, firstly, the type of goals that you've got out of your investment portfolio. And when it comes to then balancing the risk in there and the diversification, working out what portion of that portfolio would then be allocated to an individual like myself. If you're looking to chase some higher gains, I wouldn't recommend somebody like me making up a large portion of your portfolio because, as we said earlier on, you're never really going to get that. But if you were sitting there saying, well, I want half of my portfolio copying two traders and I want one of them to be growth-based and one of them to be value-based, I would obviously fit more the profile of the lower risk value end of that. And you might follow, somebody else for the growth aspect. So yeah, very much a case of, fitting the profile of managing the risk and the foundation of somebody's investment approach.
And just to make it abundantly clear, who shouldn't copy you?
Any individuals looking for big gains, chasing, speculation within the crypto market. It's not an area that's completely in my circle of competence, so I don't play around with it. I don't sit there thinking all crypto is going to zero or anything like that. My view on it is just a case of, we don't know exactly what place it's going to have in the world, right? We don't really know yet because it hasn't established its place. It's still a very, very new asset class. So for me, I'm not going to speculate on that area of the market. So if somebody was looking for trying to gain, make some bigger gains, chase some bigger gains, have some crypto exposure, things like this, then I wouldn't be the individual for you as a copier.
And what makes you so special?
I think what makes me special is a sense of I'm very detached emotionally from my investing. That might make me sound very cold, but for example, the first half of the first quarter of this year, I guess we should say, you've seen all sorts of people freaking out and stuff like that. It honestly doesn't bother me in the slightest. If I have a negative month or anything like that, probably part of that comes down to experience. We're pushing 9-10 years almost now of being around markets. I've been very fortunate of who I've been around as well across the years, and it really has instilled in me that emotionless sort of side. When it comes to managing money and taking care of things, it's not that I don't care, obviously, but it's very easy for me to detach from it and go, right, the market's doing what it's doing. Why is it doing that? How does that affect our portfolio? Am I still aligned with my goals? Am I holding the right type of assets? Is my risk balanced, etc.? And as long as it is, I'm very, very good at then, containing those emotions and sticking and following to a process. You're not going to see me making any rash decisions and suddenly start damping things and changing my approach because the market conditions change, basically.
What changes would you like to see on eToro?
Well, as far as I'm aware, I know that when you, depositing funds just into your account generally, there's like an option to do that on a regular monthly basis to make regular deposits. As far as I'm aware, there isn't an option to do that with copying someone. So like somebody might do with an index fund, for example, like a Vanguard, you could set that up automatically. You might put a couple of £100 a month into an index fund and you can literally just never touch that again and it will just do it for you every single month. Well, some people may like the option to be able to do that with somebody that they're copying. So they may want to, on a monthly basis, add to that copy and just kind of treat them almost like an index fund, I guess you could say. As far as I'm aware, that feature isn't in place. And I think that would be quite a good feature to have in there for people to be able to regularly add without having to do it manually anyway to the people they're copying, because for them, that may be the bulk of their investments and they're leaving it to that particular PI to deal with. So I think that would be a really good and useful feature for people to have.
Anything else?
To be honest with you, I know, sometimes you see some negativity on the news feed and stuff like that, but I think as an overall platform, I'm really, really happy with how eToro typically operates. In my personal experience, I obviously can't speak for others, but my personal experience is that my particular account manager, she's always come back to me very, very quickly, always been, as helpful and as possible as she can be. So yeah, my genuine, honest feedback is that I really think the platform itself runs in a really good way. Nothing's ever going to be perfect. If you've got millions of users on any platform, it's never going to fit everybody perfectly. But I can honestly say from my personal experience that I think the platform itself works really, really well. So I don't think there's too many drastic changes that would particularly be needed, from my opinion anyway.
What other PI do you recommend I talk to on Copytraders Club?
Well, the person that I think has a really well-rounded approach, and I hope I'm not going to butcher his name here, is Jeppe?
Well, he's been on.
Yeah, I know he's been on, but I'm not too familiar with too many PIs. I don't kind of follow anybody on there. I don't, and the reason I do that is part of my way of sticking within my process. Right, I tend to block out a lot of. For example, I don't follow a huge amount of different pages on social media channels. I don't sit there watching the news. I very much play a bit of a man on an island. So I use that same approach when it comes to eToro. I don't sit there, and maybe, that it could be something that I could benefit from, but I feel like it just works best for me is that I don't interact with too many PIs and just people in general on the platform. I don't want my views and processes to be too influenced by outside noise. So I tend to try and filter that out. And like I say, that just works very well for me across the board when it comes to, news, market news or social media and all these types of things. I really do my best to try and block out as much noise as possible. So the general honest answer is that I don't sit and follow any PIs, and outside of the most obvious names, I couldn't tell you too many popular investors, and it just fits me best basically with my investing approach.
So I guess I needn't ask if you meet up with any other PIs for a pint in Kent
Nope.
or South London.
I literally don't speak to many of them.
Okay, final question, Ben. What's the one question that I didn't ask in this chat that you wish I had have?
Well, I guess it's a bit of a difficult one, but I guess for some people, it would be good to get more into the nitty-gritty of someone's investing approach in terms of how they maybe screen or select certain stocks or generate certain trading ideas. That may not suit everybody to get asked that question. I know some people are very, not secretive, but they don't like to go into it too much, within the nitty gritty of their approach. And of course, that may not necessarily, benefit some newer beginner investors that may be listening. But I feel like for some of the advanced people, that really could be beneficial, or people that maybe have been trying for a little while, maybe struggling a little bit, maybe to hear certain processes that people use to filter out ideas a little bit better, may be of benefit. But of course, as I say, that's not going to benefit everybody. So it's obviously trying to create that healthy balance, right?
Yeah, sometimes I do wish I could speak a bit more about that kind of thing. Anyone who's interested in hearing more about your processes, where's the best place to get that information?
But of course, the obvious place is to make sure you're just generally following me on eToro. Obviously, it may not be suitable for everybody to copy me, but if you follow me on there, you'll be up to date with any kind of posts that I make. Of course, the YouTube channel as well. If you just simply search my name, Ben Sparham, that should come up pretty easily. And of course, the obvious one, apart from that, is of course my website. So just ben-sparham.com. You'll find all the sort of good bits and pieces that I put on there with my online courses, etc., and any kind of other services. And if you've got any general questions, feel free to shoot me a message through the contact form on there, and I'll always do my best to get back to everyone as best and as efficiently as I can.
All right, Ben. Well, look, it strikes me that you have a very solid platform. You know who you are as an investor. You know your approach inside out. You've got your website. You've got your YouTube channel. You've got your intro theme tune. Everything's in place, you know. And it really wouldn't surprise me if, with a bit of patience, you became much more of a name over time in eToro.
Well, hopefully that'd be the case. And the main objective for me is if I can help people to sort of learn and progress their own skill set a little bit, whether that be, you know, sort of copying me and they benefit from that, or whether it be from the learning side of things, however that is, you know, it is something that I genuinely enjoy doing. I enjoy, you know, speaking with others and helping others as much as possible without sounding too cheesy about it. It really does, you know, it's something I take pleasure from, basically. So, it'd obviously be good to help people as much as possible, and hopefully, yeah, my exposure grows on the platform, grows on YouTube and places like that. But I'm a patient person. I will stick to my guns. I'll make sure I'm focusing on the quality, and if that means some slightly slower growth, then so be it. You know, at the end of the day, I want to provide that quality and professionalism rather than just chasing the clicks and the likes. So that's just the way I want to do business, basically.
Well, he's doing the business on eToro. That was Ben Sparham. Thank you very much for joining us at Copytraders Clubhouse.
Absolute pleasure. Be back anytime, Gavin.
All right, cheers.
Oh, thank you very much for having me.
Ben Sparham there. Thanks to Ben for dropping by the clubhouse. At a time when many copiers are considering whether their PI lineup could use some more variety, perhaps some more stability, PIs like Ben could become more attractive inclusions. Since we recorded, Ben has made a new YouTube video showing how he screens stocks for his eToro portfolio. Link in the show notes. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything here in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit chat. We don't know your individual circumstances, etc., and so forth.